is the RRR? The Reserve Requirement Ratio, RRR, is the portion of a bank's deposits that must be kept as reserves, ensuring financial stability. By reducing the RRR, China allows banks to lend more money, potentially boosting economic activity. This move can spark growth as increased lending leads to higher spending and investments. However, such policy changes often signal underlying challenges. Economies don't adjust the RRR during boom times, they do so when the economy needs a jumpstart. Why is China's economy slowing down? Despite its status as a global manufacturing powerhouse, China's economy has faced significant headwinds recently. Pandemic aftershocks. China's recovery from COVID-19 has been slower than expected, with consumer confidence and global demand remaining weak. Property market crisis. The real estate sector, a key driver of growth, has faced turmoil, with companies like Evergrande mired in debt and unfinished projects, shaking investor confidence. Global challenges, geopolitical tensions, inflation, and high interest rates in major economies have reduced global demand for Chinese exports, further straining its economy. The impact of the RRR cut on China. China's RRR cut is a clear attempt to stimulate growth. By encouraging banks to lend more, the government hopes to boost consumer and business activity. But will it work? Risks of lending. While increased loans can drive investments in productive sectors, there's a danger of funds fueling speculative bubbles, particularly in the already fragile real estate market. Consumer hesitation. Even with easier access to credit, economic uncertainty might deter consumers from borrowing or spending, limiting the policy's effectiveness. Global ripple effects. China's economic decisions rarely stay within its borders. Here's how the RRR cut could affect the world. Commodities market, lower demand. China's reduced appetite for raw materials like steel, copper, and oil could hurt commodity exporting nations like Australia and Brazil, impacting their revenues. Oil prices. A slowdown in China may ease global oil demand, potentially lowering prices. While this might benefit consumers at the pump, it could strain oil-producing nations like Saudi Arabia, Russia, and the US currency markets. A weaker yuan, often linked to China's economic troubles, makes Chinese exports cheaper, but pressures competing economies, impacting global trade dynamics. Financial markets. Investors interpret China's RRR cut as a double-edged sword, a proactive measure to stabilize the economy, but also a signal of deeper challenges. This uncertainty can trigger sell-offs, creating ripples across global stock markets. Global inflation. If reduced commodity demand eases inflationary pressures, some countries might experience relief in rising prices, particularly for essential goods. Opportunities. Amid challenges. Despite the challenges, China's economic slowdown could drive innovation. Businesses may adapt by developing new technologies, exploring untapped markets, or rethinking their operations, much like many individuals discovered hidden talents during the pandemic. Lessons and takeaways. China's RRR cut offers several important lessons. Economic vulnerabilities. Even the world's second largest economy isn't immune to challenges. Balancing growth. Rapid growth can lead to bubbles, while stagnation can stall progress. The key lies in maintaining balance, interconnectedness. China's economic health is deeply tied to global markets, reinforcing the idea that what happens in Beijing reverberates worldwide. The role of government. China's government is taking aggressive steps to stabilize the economy, from infrastructure investments to tax cuts. However, these short-term measures could lead to long-term challenges, such as overbuilding or increased debt. Balancing immediate recovery with sustainable growth is the real test. Why should you care? China's economic struggles impact ordinary people worldwide. Delayed products. Slowdowns in China's supply chains can lead to delays or price hikes for everyday goods like smartphones and sneakers. Lower inflation. Reduced commodity demand might help ease inflation globally, benefiting households. The bigger picture. At its core, The RRR cut underscores the cyclical nature of economies. Growth isn't linear, it ebbs and flows, shaped by policies, people, and global events. As we watch China navigate these turbulent times, let's remember that adaptability, innovation, and resilience are essential for overcoming economic challenges. Thank you for joining this exploration of China's RRR cut and its global implications. Remember, the economy is about more than just numbers. It's about people and their decisions. So stay curious, stay informed, and always keep an eye on those reserve ratios.